Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
Hey everybody, welcome. We're just going to give it another minute or so to let some more people roll in.
Hi everyone. It's too bad. I really wish I could see everyone's face. I hope everyone's doing well. It's been a while since we've had a little update. So while he's, getting the screen ready, I just want to remind you at the end there's a Q&A, and you can raise your hand if you have a question, or you can type in the box below. You'll see it. If you have any questions, just let us know. Okay, we do have several that you wrote in ahead of time. Thank you for that. But of course, we're always willing to answer as we go along as well.
I think we got some good questions this week.
Yes, we do. Yeah. I always like that. We're going to dig right in. I was talking to Paul earlier, and I was really hoping that we would be able to play some music. Paul, you can go right to the first slide. And I was just going to ask him to play a song called Tell Me Lies, Tell Me Sweet Little Lies, because
it's appropriate for the information we're seeing.
Yeah, I don't think ever in the history of 36 years of me being in this industry did I realize that 2 negative GDP quarters has always been defined as a recession. Always. 36 years. I'm an economic major. So is Paul.
Yep, that's what we learned. Definition going to classes. Yeah. That's how they define
36 years in the industry. 2 negative GDP quarters equals recession. So I think apparently maybe that definition is changing, or somebody, I don't know. Something's off. Anyway,
so before we really dive in, just to give you a brief overview, we're going to cover our regular risk indicators that we watch, give you a quick update there. Mm-hmm. We're going to dive into some interesting thoughts on what we're seeing in energy and the energy space, and then go over some of the themes that we've talked about in past presentations, just around the US dollar, interest rates, and sort of consumer sentiment and behavior, and what we're seeing in the spaces. Yep. And then we'll round out with some charts of the market at the end. And then open it up to questions. We have a bunch of great questions that have come in earlier and throughout the week, so we'll get those. And if you have any questions, there's the chat box or the Q&A button in Zoom. You can click on that, type it in, and we'll make sure to answer it.
Yes. So let's just start out here. Let's start out with equity volatility. It's low. Very frankly, let us tell you that I want to say it was about 5 or 6 weeks ago that we had the sense that going into the election cycle that a few things would take place that indeed did take place. And one of them is an equity bounce. Now, why is that? Because it doesn't matter who's in office. There's, we know just by our work for so many years that there is some manipulation that takes place. And so, of course, the incumbents want to get in. And so there's we believe some manipulation. It was predictable to us that the market was going to have this bounce. It is having a bounce. We believe it will have a bounce going into the election. You can see volatility is way down. We expect actually volatility to come down even more at this point, because everything is pointing towards this continual bounce. So,
and again, those not familiar, this just sort of is a gauge on what the implied move in markets will be at 30 years forward. So it's looking forward, saying, okay, how uncertain is the future over the next month or so? And what do
30 days forward, not 30 years.
30 years? Yes, we did. Yeah, 30 days, not 30 years.
Yeah, 30 days.
And so when it comes down, it's just saying that there's less thought that there's going to be these events that cause a lot of uncertainty in markets.
Yeah, this is more or less, to me, it's supposedly a leading indicator, but I look at it more like a coincident indicator, really.
And just to go back, the chart we looked at was an aggregate of a whole bunch of different volatility measures. This one is specifically the VIX, which specifically looks at the stock market.
Yeah, and you can see it broke that what you see Paul put in 2 purple lines. It broke below one of the resistance or the support lines, which again, like when I said that we anticipate because of that break, actually, that it may go down and retest a low. And why is this significant? It's significant because usually, well, always the VIX, not every day, but the VIX and the markets will trade opposite of each other. So the lower the VIX goes, the more likelihood that the S&P 500, the Dow, the NASDAQ will go high. Okay, so that break to us says, a retest to the low would not be out of the ordinary and actually would fall script to what we are generally expecting. Yeah.
Right, so credit default swap spreads, again, simply put, it's a measure of insurance on, or the probability of a company going belly up or defaulting on their loans or on their debt. And the risk has come down slightly in these markets. So again, this isn't flashing huge concern. I mean, the trend is moving higher, which ultimately, when we zoom out, says, okay, markets are saying that there's greater chance of companies going default. But in the short term, at least, they've pulled back some.
Yeah, and this isn't really significant yet. And it's in the slope of the curve that matters to us. At the beginning of this or middle of this year, it was higher. Just because it pulls, this is not, again, out of the ordinary, something we didn't expect, given what we thought was coming over the next few months. So really important for us to say that our prognosis of the market, our concern about the market and the economy remains. And you're going to hear that as we go forward. Okay. So all we're expecting is a bounce in the market, not necessarily a resumption of a bull trend. Corporate spreads, what you're seeing here is overall, you're seeing spreads rise. That's continuing. We do expect rates to go higher, despite what we might hear. Core inflation isn't really running any lower. I don't know. I think it was down 0.1% over the month. Was it 0.1 or 0.2 or something? Yeah. So it's the headlines making it a big deal. That's not a big deal to us. So corporate spreads still going higher, showing that there's a little bit more risk, but again, not anything to run to the door with.
And this would make sense too. This top line looks at junk bonds, or the sort of highest risk category in fixed income. And to see that it spikes higher, those are the companies that are going to default on their loans, have a harder time first, as opposed to the higher grade or higher investment grade type companies.
Yeah, nothing here flashes a concern about credit at this point. Yield curve. Funky looking yield curve for those of us who've been in the industry for a long time.
Looks weird.
Yeah, and it looks indicative of recession. We're there. We believe we're there. Many people say we're not. Well, 2 negative quarters of GDP from an official definition is a definition of a recession. But you're going to need to ask the people who are in the middle, low middle, and lower income classes, and surely they will tell you we are in a recession.
I wanted to include it in this chart deck, but I didn't get a chance to add it. I sent you the breakfast index.
Oh, shoot.
It's an index that we'll maybe send that around. But it's an index that tracks the price of eggs, orange juice, milk, everything you need to make a nice breakfast, and it's at its highest level that it's ever been at.
So, but what's more important is the spike. So, you were flat for so many decades, and then in the recent months, you see it just like the trajectory straight up. So we'll have to, maybe we can pull that in at the end.
And when people talk about the yield curve inverting, essentially what that means is that short end, which is down here, rises above the long end, which is on the right side. Ultimately, it says there's less faith in long-term prospects, right?
Yep. Okay, so that's the inversion. Okay, so here's the treasury bonds, and you can see we're right up against previous highs in rates. The question is, are we pausing here, Paul? I'm sorry, I'm going to
Yeah.
take that so I can play with this too. So are we pausing here, which wouldn't be unusual. But we do see, if you look at, I don't know if we broke it out by each year. Did we break it out differently? Maybe not. There's another chart. Ooh, no, we don't have it here. Okay. Yeah. So anyway, you can see we're right up against maybe some resistance. You know, there's some talk deflation. We don't see it. I just, we don't listen to headlines, really. We don't look at headlines, but sometimes when I see them cross over, I think, what are they talking about? Because the data doesn't show it. The core, yes, at the pump,
Prices at the pump have
are
come
down
down.
$1, which we expected. Again, we knew going into the summer there would be this relief just because, you
But
know,
they're
they
still what, 3 times higher than
they're 100% higher than they were a year or 2 years ago. That's for sure. And so, you know, we just think this is a temporary reprieve. We don't see this as significant. And we're going to show you why that is. We do have some of that data in here. Okay.
We'll go right into.
Oh, here we go. Here's
segues
why.
Perfectly into energy.
Yeah.
We wanted to show this chart because it's concerning. I mean, it shows the stock or the available petroleum that U.S. has from not just the strategic reserve, but also, you know, all the holdings of different companies and whatnot. And we are at
All-time low.
really historical lows here. This top dash line is the 7-year average where, you know, the stock of petroleum should be at. And this is where we're at today, a significant, you know, 300 million barrels lower than what the average has been for the past 7 years. It's highly concerning considering that there are still major geopolitical tensions that impact energy prices. There's news that has come out of major refineries that have caught fire and actually burned down. That process huge. So it puts a lot of fundamental strain on these markets, which are very concerning for us going into
the
winter.
heating season. So it doesn't. Okay, yes, we know prices at the pump have come down a whole $1, okay, roughly across the country. And at the surface, I think most of us have very short memories, but it's still 100% higher than it has been. So we can't forget that. But more importantly, when you look at this chart and some other data, I don't know if we pulled in some other information, but when you look at what's happening with energy across the globe. So number one, conflict. Let's just, you know, conflict over in Europe and with Ukraine and with Russia, but it's trickling all over the place. When you see what's happening in Europe, the increase in prices there for heating, when you look at the strategic stock, so we've actually sold some of our strategic petroleum reserve to China. China's perfectly fine buying their reserve, their oil from Russia. So this is a head scratcher to me because strategic reserves we usually use in times of turmoil and in times of problems. That strategic reserve, if they wanted to have it, it should have gone to the American people. It should have gone to that disenfranchised group of people that are being severely
the
affected.
idea
by this.
of selling, you know, off the strategic reserve is, you know, under the guise of lowering prices for people. Yet the process by which they do that ultimately is an auction that they held where they then sell that to the actual highest bidder. In this case, the last sale was actually to China and not to the American people.
We don't do this. This has not been done historically where we just sell this off. So this is a conflict for me and conflict for Paul as to why we're doing this now at a time when prices have gone higher. So you could see inventories are down. When you see that, look at how low this is, the 7-year average, look at where we are now. That doesn't lead to a softening in prices.
Right.
So we think this is really temporary.
Supply down, demand up.
Yeah.
This is going.
And so when you look at the inflation number, the recent print, most of the decline was due to energy. Okay. So if that being the case, we go into the heating season, what will happen from here? That's the big question. I don't like it. Okay, so this is why I say tell me lies, okay? Because, you know, we closed down, one of our gas pipelines was closed down. Now, for those of you who know, please know I'm energy independent. I have a house that's off the grid. I can pull anytime on the grid, but I can pull anytime. I don't use anything from the grid at all. They owe me for the last several years since I've moved there. So, you know that I like to be conserve energy and so on. That's just in my backdrop. But one of the things that bothers me is this lie around electric cars, okay? And then shutting down the pipeline. We shut down a pipeline that was working, and now supposedly on the guise of carbon and trying to improve our footprint. But this yellow spike, Paul, show it, please, right there. Right, that's our consumption of coal globally. So, since 1985, we're at the highest level of coal consumption in decades.
And we're all for moving to alternative energy sources, totally. But you need to have a thoughtful pathway and plan to get there, not just blanket, okay, let's shut down all of these traditional petroleum-based or hydrocarbon-based fuel sources and just hope that something new pops up. No, we need to have a actual pathway to get there. And unfortunately, it seems like a lot of the latter's happening where
it just makes no sense
to have coal jump that much, coal use jump that use in the world as a whole. I mean, it's unacceptable.
Yeah. So I think it's fair for me to say part of the concern, the reason I'm revved up, I would say, is we have a whole group of disenfranchised people in our society, and it's getting worse. That creates massive destabilization. And number one, neither one of us want to see anybody suffer. That doesn't feel good to me, and anybody have a hard time. That's hard enough. But then what the ripple effects of something like that does to a society, it becomes destabilizing. And that is a concern.
And these kind of slow incremental cost increases, the top 50% plus can weather them for the most part, but the majority or the bottom socioeconomic tranches, they feel the brunt of this much, much worse.
Yeah. Anyway, so I don't know. So here's again,
this chart.
I know.
This is data from the Federal Reserve, but this black line down here looks at what federal minimum wage is. Okay, and these lines above it are if minimum wage was to track maybe things that make more sense, like if minimum wage tracked the actual reported inflation rate, instead of $7.25 an hour, it would be $11.21. If it instead tracked the median actual wage, it would be closer to $17 an hour. If it tracked GDP per capita, it would be closer to $26 per hour.
Which would make really more sense, actually, because this kind of dovetails into the question somebody had around productivity, which I think is.
And if it tracked corporate profits, you'd be looking at $48 an hour for minimum wage. So clearly there's some structural issues here that
See, this is the destabilization that we're like to 36 years in the industry and watching this one policy after the other that I would consider flawed create an environment like this in the long run. It's very hard to see. It's hard to see this. And it's not just current, it's been going on for a very long time. What's next? Social unrest.
Some interesting data points we ran across. Starbucks is closing a lot of its stores, and some of the reasoning that I guess the CEO said was
it's not safe. It's dangerous. There's too much crime in the areas. People being found in the bathroom sleeping. Homelessness. It's crazy. The sightings as to why, and I found it interesting that I had to listen to the conference call just to hear a little bit further. It really does have to do with some safety. It doesn't have to do with a lack of growth, really.
And this goes to our point about, the social fabric being torn at due to policies and sort of where we're at as a society. And then Walmart laid off
first time
hundreds of corporate workers, right?
Yeah, so first time that they actually had some layoffs, which was I found
sort of a canary in the coal mine.
I think a canary in the coal mine about the economy, because already people are talking about that it's not that bad, but we look at data trumps everything to us. The dollar.
And a bunch of headlines on the thesis we've talked about many times about how the US dollar is under threat. Here's even more, I guess, ammunition for that. Recently, Turkey said that they're looking to settle a lot of their energy trade in rubles with Russia, and that they have no issue with that. Saudi Arabia is looking at accepting yuan instead of US dollars for their oil.
So why is this significant? Because remember, we've been through this before. The US, we went from the gold standard to the US dollar standard in the 70s. The US dollar became what they called the OPEC dollar. So all trade in energy is not mostly done in the US dollar, some in the euro, but I'd say 90% in the US dollar.
Majority of energy trade is done.
And why this is a big deal? Because for those of you who know, supply and demand. So if there's less demand for the dollar, therefore there's more supply of the dollar, generally you see the price of the dollar to come down. Now, we have not seen the price of the dollar come down over the last, we didn't put that chart in, did we? No, we don't have it. No, it's okay. The dollar has been in a general trajectory to the downside over the last several decades. So now, and it hasn't really come down, it's actually bounced recently, but that's because we are raising interest rates when the rest of the world is not doing so at this time. So that's going to support the dollar. But you have to remember, in the end, it will come down to supply and demand. So if the demand for the dollar begins to come down, which we're starting to see, and this has been a thesis for 10 years, and it's a long-term thesis that the dollar will not be, that we think we will go to a basket. Why is that significant? Because all trade gets done in the dollar, which means we have a lot more control, if you will, over pricing. Okay. If the dollar eventually does come out of the basket, we will see permanently prices go higher because we import so many things.
There are a lot of benefits to being the sort of world reserve currency. It allows us really to print a lot of money too,
and dictate
without consequence. But if you're no longer, if that demand is no longer there, you can't print without consequence.
Like Argentina, if they printed and they had massive consequence, and that happens. So,
and this interesting headline about multiple European Union countries who are still buying, or actually said they would buy Russian gas regardless in rubles. So that's
I mean,
doubly concerning.
Yeah. I mean, there's, that's again, quietly being done. So, yeah.
All right, some charts. Here's our S&P 500 chart. We're at this sort of resistance level here. We've hit it. It's right where the 200-day moving average is. We would expect potentially a little consolidation here if it breaks through. At least for the short term, that's relatively bullish. We could see that happen due to elections, maybe a slight pullback. Otherwise, we'll see.
Let's put it this way, and I think it's really important. Our thesis around being conservative remains, but you do know we've added some things to your portfolio just to take advantage of this trend. Unfortunately, buying and holding in this market just isn't prudent. It's just not, because we do think we're going into a recession, and we don't think the Fed is stopping. In fact, I think they announced yesterday that they're not going, they're going to continue. And it only makes sense. The only thing I can do, there's some people here I know who've been in business in the 70s. The only way I can liken this is to, it whiffs a little bit like a stagflationary environment. Except that, let's call it more of a, what were we dubbing it? Reverse stagflation, meaning the cost of necessities are where we're seeing the pricing, like in food and energy and health insurance, taxes, fees, all of that. That's where you see the pricing power. So, having said that, we don't think the Fed is going to stop, but we also don't think the Fed is really going to be able to have a big impact, because it's on mostly things that are needed. So back to this point about this, we're right at trend line. We would expect a pullback at this trend line. If our thesis is right that things will stay relatively calm until election, then we'll continue to take advantage a little bit about some of the recent buys we've done. The NASDAQ, same thing.
Here's the NASDAQ. So it broke through, hasn't hit its 200-day yet, but
I want to also make sure you know that bull markets don't resume in a V shape. Okay, so that's also something you need to know.
Technically, right, we'd be looking for a consolidation or troughing period where it kind of moves sideways within a range.
Which found it, yeah.
Because that really just says there's indecision in the market, but the longer that goes for, the stronger that base gets built. So
Yep. And next, what do we have?
that's it.
Oh, is that it?
Yeah.
Oh, we have tons of questions, so make sure we have some Q&As, Paul, so pull those up while we, I'm gonna launch the first question here. Do you believe that the Fed is forcing the US into a recession with signs that there is slowing of economic growth? Yeah, I mean, I think, yes, the answer to that is, I think we already answered it. We think we're already there. And if you probably ask the lower 60% of our population in terms of, you know, socioeconomic status, I'm certain that they would say we're already there. Yeah, we're already there.
Yeah.
So yes, unfortunately. And so what's going to win out is the question, is our interest rates going to win out, or the concern about recession? We see that in China, what they just lowered rates in China. Yeah. So what's going to win out? Is it going to be high? Is it going to be that they're more concerned about recession or more concerned about inflation? That's the question. And so why did the US stock rally in July when inflation data reported in mid-July was the worst in 4 years plus? It's to our point that we think, you know, we're seeing a little bit of pricing come down at the pump. We think that there's a little manipulation. If you look at the market, there's very light volume.
Right, it's light volume in some of the data and articles that we've read and seen are saying there's a big piece of retail FOMO, or fear of missing out, that happens too, where people, you know, they see a dip and think, you know, for the past 12, 15 years, you buy the dip and it works out. So, you know, you see this pullback, you buy, but
very good point.
So that can work to start making the markets move higher, and then a bunch of the CTAs and algorithms kick in that do it. But if there isn't that fundamental case behind that, it can just as easily fall apart.
Yeah, the other thing is, remember that I've said this before, I always look at the markets as a breathing, living mechanism that has an in-breath and out-breath and in-breath and out-breath. And, you know,
just go straight down.
It feels like it's going straight down, but really when you look at our work, like we knew, if you remember in October, November last year, we were looking ahead and saying, looks like there's going to be a recession ahead. 6 months ahead, always the market tells you there's going to be a recession. Well, sure enough, it did. It did in November, October. October, November, December started to break down. Even though it was hitting a new high, the components underneath the surface were breaking down. So the market, it's living and breathing, and it's going to have those relief rallies, and then it's going to have its correction. That's typical. When Paul was talking about the churn at the bottom, that's what we like to see. We like to see that long slog of just up, down, up, down, up, down in a nice long trend line. That to us is the best time to buy. That's when we'll say we can buy and feel comfortable. Yeah, so hopefully that answers that question. Is the US in a light cycle expansion phase? Yes. With possible moderate recession risk? Yes. While Europe is facing rising near-term recession risk, no question. I mean, Europe is in some bad shape right now. I know that you're not seeing this, I think, necessarily in our numbers, but heating there, it's always been a lot better than here, but you were paying like 59 cents, something like that per, I don't want to call it therm, I'm not really sure how you do it, up to now the heating, they know the new bills have come in from the gas companies at 2.49. So 59 to 2.49. That's what they're going through. So that is a big shift for them in terms of heating. Yeah. So is that going to be recessionary? No question about it.
Your gas bill 4x.
4x, more than 4x.
More than that,
yeah. So already there's a slowdown there. So that's definitely happening, but their consumption isn't quite like our consumption. So that's definitely okay. Does macro level analysis generally assume that the prime way to increase wages is with higher productivity? The period from 1980 to the present, this is true, has shown productivity growth in the US has been much lower. Yeah, so our productivity growth, it depends upon like what period you're looking at. So like in the 90s, our productivity growth, if you remember, grew pretty solidly. If you're looking at the average over that since 1980, no, but with the advent of technology in 95 to like 2001, productivity gains were there. And actually in that little time spurt, if you remember, I know who asked the question, if you remember the headlines, people were leaving jobs without jobs because they were getting more wages. That's what was happening for a while in that time period. So it always depends upon where we are. Just before this period of higher inflation, we were seeing wage to tick up for what, like about 6 to 8 months, was it? When there was a little bit of, and correlated with that was some productivity gain from AI. Suddenly that's actually reversed recently. So yes, your question is productivity growth does make a difference, but then it also creates problems for a whole other group of people who could become unemployed. Do you think I answered that?
Yeah.
Okay. Yeah.
Also too, it's many of the, I want to say low hanging fruit or easily automated away jobs have already been done or you know, are in process. And so technology needs to exponentially increase to tackle the more complex and complicated. So it takes arguably longer time to do.
Yeah, but here's the other thing, you know, productivity gains are coming from automation too. So you have kind of a weird situation where you're getting some productivity gains from automation that displaces a whole group of people. Like it happened. So in that 95 to 2001 period where there was productivity gain and you had bigger wages, it came off of a big period of layoffs and unemployment because the gains we made during that time period automated so much. I think we're going to have that same type of cycle because of AI and robotics. So I hope that answers your question. If not, you just, you know, write something in the little blob there so we can answer it a little bit better. So next one.
Is it a good idea to pay off mortgages? Take profits when the market's up, or right now sit for the long term?
Yeah, so this question, is it a good idea to pay off a mortgage, take profits while the market is up, or think the market will be up for a long time? So let's answer this in 2 phases. One, it depends upon your specific situation. So we strongly advise you call us and have this conversation with us. It depends upon where you are in your life cycle. It depends, like, you know, are you, you know, employed like we are at this point? Paul's at the, you know, just coming up. I'm at presumably a peak place. So depends upon where you are in your life cycle, and depends upon what and your appetite for risk and so on. I think interest rates, I think debt, if used wisely at the right time of your life, is phenomenal. But debt at 65, not so much. I'd rather see people have everything paid off.
Yeah, it really depends on your personal situation and many other factors. We can't really make a blanket statement here.
Yeah. And then do we think the market will be up for a long time? Well, what we think is that we're still in a bear market, though nobody really wants to talk about that very much. But having these bull runs in a bear market is totally normal. But overall, do we think there's a rolling process? Yeah, we think that's pretty likely.
Right. I think I read an article that said on average, there's about 3 to 5 or 6 different bear market rallies that happen in a typical bear cycle, where you can see gains of anywhere from 20 to 50%, but it's still in that downward trend over the longer time frame. So just something to be mindful of.
Yeah. And somebody asked a question about crypto, about if they should move their crypto off of Coinbase into a ledger. And I guess getting your private keys is what you're talking about. And that's something, again, you can ask us independently. If you're comfortable with that process, then, you know, by all means, really it's going to be secure. It will secure
you. On your, you know, your ability to understand what's necessary to take self-custody and protect yourself that way. And as long as you have the knowledge base and the ability to, you know, log in and do some stuff on a computer, you know, maybe it makes sense for you, but it's really situational.
Yeah. I mean, like, I need help when I do something like that. So, you know, and I'm not like I'm not tech sophisticated, but still it's a very complicated process. So I would really encourage you to call in and set up a time with Paul or myself on that one. Okay. And so there's a few other things that we wanted to comment on. Paul, somebody asked about Kathy Woods.
Yep, we had a question around thoughts on sort of Kathy Wood's, the ARC innovation ETFs that they have. It's a very interesting suite of products that they have. The thing to really keep in mind is that during timing. And during a bull market, that kind of stuff makes sense. When money is cheap and easy, those kind of investments, like the underlying companies that they're invested in, make sense because they're able to finance their operations for free pretty much and take on as much debt as they want with a very positive consumer behind them backing it, really looking forward to the future. When interest rates rise and sort of that narrative or the bigger macro behavioral economic picture changes, these companies that don't currently have growth, even if it is a great idea, even if they are working towards something amazing, they will get destroyed in their price, which we've seen across the board.
It's some of the holdings in those ARC funds we've owned, like Zoom, like Spotify, like Shopify, like Zendesk. And we owned them. Thank God we got out much, like close to the 52-week highs on most of them, not all, but close. But they have been destroyed. They're down, some of them 80% from their high. 80%.
This isn't cryptocurrency. This is stuff on the stock market. NASDAQ.
Yeah, exactly. So what do we think of them? Well, it's a exchange traded fund, and it has to be timed. I think like anything else, if you got the right timing, you're good. If you didn't, you'd be down 50, 60%. I think she came out recently to say she believes we're going to go into a deflationary environment. This seems to be something I hear more and more people in our industry talking about. I don't see it yet. I really don't see it yet. I don't see it yet in the food supply. I don't see it in shipping. Maybe housing, maybe there, but even there it's slow to move. Yeah. Let's see.
All right.
You want to talk about that one?
So it's around Biden's switch to a trackable coin-based currency to take advantage of blockchain technology. Long term, I don't see a future where, I could definitely be wrong on this, but I don't see a future where the US government, really, or any government, doesn't move to adopting either a central bank-backed digital currency or some type of public-private partnership with a already established stablecoin type cryptocurrency that's already audited, plainly because it provides a level of insight and control into how that currency is used that really regulatory minded people could only dream of.
Yeah, and for those of you who might have seen that they recently there was an announcement that the central bank will back some of the crypto banks. That was earlier this week. I don't know. And then
a few episodes ago, we talked about the was it the Bank of International Settlements, or one of the major like the global Fed, pretty much saying that they would allow their member banks to have Bitcoin and different types of digital assets on their balance sheets. So.
Yeah, that's a big deal. So there's some viability. We continue to say there's viability there. Well, there's certainly, if there wasn't, we think it would be gone by now. Structured products. Structured, what was the question?
Is it safer?
Okay. Structured products. Are they safer? Are they a good defense for market volatility than annuities? And it depends upon what kind. We're not big on structured products.
Yeah. They introduce a lot of risks that aren't really you're not really made aware of.
Liquidity, high.
A lot of times they involve buying a company or an underlying thing like a stock or a bond, and then using options or some type of leverage to
There's
play
actually
on
more
it.
risk in those sometimes. So it just depends. If you have a specific situation, again, you want to bring to us, please do. We welcome that. So let's see. Do we have anything in the Q&A, Paul?
Apologize,
okay,
we got to
here we go.
read this. All right, let's see what we got.
Old eyes. Well, his are Government changing definitions. Can I changing the definition of recession, GDP? It's not really sure what that question. Somebody asked a question reference government changing definitions. So there is some talk about them changing the definition of what a recession is. I'm not sure if that's what your question is. So, again, historically 36 years in the business, a definition of a recession is 2 years.
Ago when I did my education in this. That's how it was defined.
Two quarters
Two
negative
quarters
GDP.
consecutive negative GDP is a recession.
Yeah, so somebody was asking a question about whether the government's changing the definition. I guess so. It might be kind of convenient. I don't know. I just know what I know from, being in the industry for so long.
Will the Inflation Reduction Act stimulate the economy and raise the stock market?
I don't see it. I'm having a really hard time seeing it. We looked at the bill. There are some things in the bill that just make you scratch your head, like 87,000 new agents for the IRS. I'm trying to understand how that's going to help stimulate the economy. I don't. Let me see.
There was talk about how those agents too would not be used on people making under 400K per year. And when you actually look at the data of who they're targeting, it includes everybody.
Yeah, it does. So this is not like, I'm not too thrilled about that bill. Doesn't look like an Inflation Reduction Act to me at all. What was the other provision in there, Paul, that bothered me? Oh, methane, something around methane reduction rights for farmers, which we can go on to a whole other subject on that at a later point. But again, I'm trying to see how that is going to reduce inflation and spark. So
and again, it comes back to this idea that yes, we do want to decrease methane emissions. That is a good thing.
Totally.
But we need really thoughtful ways to get there. You can't just punish the farmer and say, hey, make this disappear overnight. It's
like
not
they're
possible.
Doing in Holland right now, if anybody's following
you need to put structure in place and have a plan of actually how do you get from A to B, right?
Yeah. So can I say, do I think it's really good? I have to tell you, I can't see it in anything that I've read where it's really going to be stimulative to our economy and to the markets. So,
I don't know when to take profits.
So someone asked, how do we know when to take profits? For example, I'm wondering about people prepaying principals on mortgage. So again, someone's asking about prepaying principals on mortgage. Again, this depends upon where you are in your life cycle, what you want to come. Like I'm 57, going to be 58. I really rather be out at this stage of my life. I'm not at his stage. And so, but
I've locked in a really low interest rate. So for now, for me, my personal situation, it makes sense to, not worry too much. But that's me and my situation.
Yeah. And then I also, full disclosure, 2.75% 30-year mortgage. Sure, I took some of that out. Why not? It is cheap money. So it depends upon the money. Where is this? How do you know when to take profits? We take profits based on, what we see happening in the macro economy. So it's really
the macro piece and the technical piece.
Exactly.
And when both sort of line up, us that says, and then we talk about it and figure out what else is going on. Does it make sense to catch a falling knife, right? When markets are dropping, you don't just blindly throw your money in. And the same on the other side. What's the saying? Don't fight the tide or fight the trend, right? Don't fight the trend.
Rising tide raises all ships. So it's, for us, we like to take our profits when we see always the technical breakdown happens beforehand. The market is a leading economic indicator. That's always the first place. So you saw stocks breaking down before we had this recession, but it was predictable because of the types of stocks that were breaking down. It was growth. So it's not, we can't just answer that like when to take profits. It just depends upon the circumstances and the situation.
All right. So
Hold on.
So on one hand, we're hearing that the dollar is strong. Is it compared to the euro?
Yeah, so it would be great if we had our chart to show you. It's strong in the short term, and part of the reason it's strong is because we are raising rates, and that's going to bump up the dollar relative to other currencies, just the way it trades. But if you look at every externality, major event that's happened, a serious event that's happened, the dollar usually used to be known.
Past, 50 years?
Yeah, 50 years.
So.
The dollar is what they call the flight to quality. So most countries would fly to the dollar because it's safe. But with each major externality, like 9/11 and the financial crisis, you saw the value of the dollar go less and less. Yeah, lower highs. So if we had the chart, you can see that. But yes, near term, the dollar is stronger. We absolutely see that.
And it is confusing because, the talking heads talk about it, how a strong dollar, but when you really dig into what they're actually looking at, the dollar index, it's a basket actually of different currencies too. So it's a little more dynamic. That's maybe it's intentionally confusing. I don't know. All right. Well, you were going to address.
No, this is not okay.
Just trying to
What's
read these questions and make some sense.
What's the purpose? Somebody asked the question, what's the purpose of lying? Are
Lying about.
Right, and about, yeah,
Yeah, okay.
Okay, so what is the purpose and the objective? One of the things we do know is politicians certainly want to get reelected and
Power consolidation.
yeah. And if you could just, convince people that this isn't happening, then maybe people would believe it.
A big part of markets is the whole idea around behavioral economics, where regardless of, and we've mentioned this in the past too, regardless of the fundamentals, regardless of how strong something might be fundamentally, if everybody is in agreement that it's not good, it doesn't really matter, right? All right.
Okay, the Fed or someone changed the definition of inflation or money supply 2 years ago. Wow, can we unmute him? Might be easier. Oh, shoot. Okay, we don't know how to do that. Sorry.
For our next one, feel free to give us a call.
How will these definitions affect your future analysis of data? Okay, so the truth is definitions aren't really gonna, they're not, the reason I point them out is because I don't appreciate having no recognition that there are people who are hurting from what's going on today. And we have to have some recognition here that this higher inflation is affecting people.
Right.
And that to us is the most important thing. Admit it. Admit that people are hurting and that something needs to be done. That's what I want to hear. In terms of why they're playing around with the definition and so on, I believe it's just simply political. So one of the things that I know, my early days in the 80s, when I started in the industry, I had a mentor who was 80, okay, at that time, who said to me, he noted, so this was in the 80s, so in the 90s, he said this to me. He said that it is becoming politically unacceptable to have recessions, and this is a problem, because it will create excess. This I didn't really understand. I was early in my career, right? It was really insightful. Yeah, very insightful. So I want to answer that this way, that it didn't matter who was in control of the White House. No matter who was there, it became politically unacceptable to whoever was in that White House to have a recession. And so what they did was they became very active in monetary policy. So when I actually started in the industry in 86, the only thing we looked at was money supply, okay? Because money supply told us a lot about future inflation, how things were going, the multiplier effect, and so on. And then probably by 1990, it shifted to all the data we look at now, which I like better, by the way. I think it's more accurate. So to your question, does the definition in the end really, really matter? No. But does the reality matter that there are people struggling because of where prices are? Yes. Yes, they are. And more concerning is it's in the things that you have to have. Food, energy, taxes. Well, do we have to have taxes? Yeah, we do, because I like roads, but they, taxes, but they're decoupling that. They're making fees now and so on. So is that disturbing to us? Yes, that's very bothersome. Yeah. So the definition, not so much, but having some recognition that we have some issues, we think some more questions might have come through. Can you get that? I think it's down. They go down to the newer ones. So there's one there.
Okay. So going forward, given current conditions, what sectors do we like?
Yeah, and so keep in mind here. So we're gonna say what we like, but it's always subject to change and can change at any time. So the sectors that we like right now would be those that have pricing power. You know, we still think that there's legs in energy. We do think that there's pricing power for, you know, we really didn't go into the depth of what's going on in gas and oil across the globe, but we do see in our work that there's still a tremendous amount of pricing power there. So anywhere where there's pricing power, that's, you know, and in particular, we really like at the core level, the farmers the farmers themselves, you know, companies that have, you know, are able to produce the food. Stuff we need. Yeah. Okay, so
Right.
any
Looks like
more
that
questions? I don't
wraps up
think
what we have.
so. Yeah, I think we're done.
Yeah.
Oh, wow.
So again, you know, feel free to reach out to us, shoot us an email, give us a call if you have any follow-up questions or, you know, want to get into anything more, or if you'd like to schedule a meeting. Yeah. All right. Well, thanks for joining us.
Thank you very much.
We'll see you next time.
Thank you for calling in. Thanks.